The stock market is near all-time highs again. The S&P had a huge monthly rally. Nasdaq ripped even harder. Semiconductors went almost vertical. On the surface, this looks like a strong bull market, but underneath, the setup looks fragile. Before we go further, this is not financial advice. This is only a market risk breakdown for research and education. The first warning sign is the bond market. The 10-year yield is still around the mid 4% area, and the long end has been near 5%. That is not a clean soft landing signal. For expensive tech and AI stocks, yields matter. Higher yields make future earnings less valuable today. So when the market is paying huge multiples for AI growth, elevated yields become a problem. The second issue is AI and semiconductor valuations. The AI story is real. NVIDIA is real. AMD's data center growth is real. Hyperscaler spending is real. But the market is pricing many AI-related stocks like everything goes perfectly. Intel ripped on reports of exploratory Apple Foundry talks. But exploratory talks are not orders. They are not revenue. They are not margin. AMD reported strong numbers, especially in data center, but the stock already prices in a lot of future execution. ARM is also being valued like a major AI and data center winner before that future is fully proven. So the argument is not AI is fake. The argument is AI can be real and still be overpaid for. Now look at the hyperscalers: Microsoft, Google, Amazon, Meta, Oracle. Wall Street expects earnings to keep growing, but free cash flow is under pressure because AI capex is exploding. That is important. Data centers, GPUs, CPUs, networking, cooling, power. This build-out is extremely expensive. At some point, investors may stop asking, how much are they spending on AI? And start asking, what return are they getting? That is where the AI trade can become vulnerable. Quick break. This is the type of setup we track inside PreTradeIt. PreTradeIt is a research-only market intelligence dashboard. It helps break down stocks before a trade by looking at price action, fundamentals, sentiment, risk, and model-based trade checks. So instead of chasing a headline or a green candle, you can see whether a setup looks strong, stretched, risky, or better to wait on. You can try it free at PreTradeIt.com. Again, it is not financial advice and it does not execute trades. It is built for research before you make your own decision. Now back to the market. The third risk is oil and geopolitics. Hormuz risk is still live. If oil spikes again, inflation risk comes right back. Then the chain reaction is simple. Oil rises. Inflation expectations rise. The Fed has less room to cut. Yields stay elevated. Consumers get squeezed. Margins come under pressure. Expensive tech multiples become harder to defend. That is the problem. The market is acting like oil risk is contained, the Fed can still help, credit is fine, and AI growth will cover everything. That is a lot of assumptions. The fourth risk is private credit. Private credit is the background risk people ignore until liquidity tightens. It is opaque. It is not marked every second like public markets. If defaults rise or investors start pulling money from illiquid structures, stress can show up late and then spread fast. A normal correction can happen from stretched valuations, but a crash usually needs something more: credit stress, liquidity stress, or forced selling. That is why credit matters. So here is the crash scenario. The market holds near highs because AI earnings are strong and traders are still chasing momentum. Then semiconductors start to fracture. The speculative AI names weaken first. QQQ starts losing strength. Oil spikes again. Yields stay elevated. Credit weakens. VIX wakes up. At that point, this can move from normal profit taking to a real air pocket. To be clear, a crash is not confirmed yet. The market can still squeeze higher. Shorting too early can be brutal. But this does not look like a clean early cycle recovery to me. It looks more like a late cycle melt-up. Strong earnings, real AI demand, but stretched valuations, elevated yields, oil risk, private credit risk, and extreme options activity. The key takeaway is simple. The market is pricing perfection while the risk stack is getting heavier. If semis roll over, oil spikes, yields stay high, credit weakens, and volatility rises, The next move down could be much bigger than people expect. Again, this is not financial advice. Do your own research, manage your risk, and do not confuse a strong rally with a safe market.